Good morning, everyone, for Premier Life and Annuities Life Weekly. Today, we have on board for our Life Weekly, Bobby Nikolai. Bobby is the Regional Sales Manager for Assurity Life Insurance Company. Today, we're going to talk about the Assurity Life's new product. It is a joint, first-to-die, whole life product. And we're going to open it up for questions. If you're on your computer, please feel free to type them in at any time during the session. We're going to take about 15 to 20 minutes just talking and discussing this new product, where it can be used, what its features are, and some ideas for you to get out in the marketplace and use this and generate some business. So, Bobby Nikolai, Regional Sales Manager, take over.
Thanks, Mark, so much. Really do appreciate it. Appreciate everybody on the line. I'm Bobby Nikolai, Regional Sales Manager at Assurity Life. And I know that you're all here to learn a little bit about our new product that Assurity just released at the beginning of October. And you may have a lot of questions. You know, you probably heard about this new joint whole life product. You're probably asking yourself, well, what is First to Die? Or you might be asking, why the heck did Assurity create this product? You might be thinking to yourself, how is Assurity going to sell this product, or what am I even going to say to try to sell this product? Well, the good news is that in today's conversation, we're going to answer all those questions. But before we answer those questions, the first thing I want to do is kind of state what was going on in a previous time in this country in 1955. So many of you on this line may or may not know the exact date that these came out, but these all happened in 1955. Jonas Salk invented the polio vaccine, and it was accepted as a way to prevent polio. Gunsmoke first debuted. Disneyland opened its doors. You know, all these events happened in 1955, and the reason why I bring this up is because a lot of these things are still around, right? And the answer is yes. Disneyland still has its doors open, Gunsmoke still airs on TV, and we also get shots to prevent polio. And my point is, some things have stayed the same, but we are consistently adapted to stay with the times. You know, Disneyland continues to add new rides, we consistently advance in medicine, and life insurance is also very similar. You know, a solution that might have worked back in 1955 might not be the best solution for clients today, and that's why we're here to talk about the First to Die product, which is a solution for today's generations. Real quick, a little bit about Assurity. We're a mutual company based out of Lincoln, Nebraska. We have 125 years working in the middle income market, and in 1955, Assurity was approximately 65 years old. So we've been around for a long time. We've been working with middle income America, and we learned a couple of things along the way working in this demographic. And one of the biggest things that we've learned is that cost plays a huge factor in middle income families purchasing life insurance. One of the reasons we designed the First to Die product is because it's actually a cost-effective way to get permanent life insurance in the hands of the consumer. And we also learned that convenience plays a huge role in getting life insurance in this demographic. So when you look through our portfolio of products, you'll see simplified products, you'll see fully underwritten products, and you'll also see non-medical limits built into these products. First to Die has some of those convenience factors been built into it as well, and I'm also going to talk about that today. Assurity is consistently looking for ways to penetrate and work with middle income families, and as a result, we design products to address the demographic. And you'll learn today how First to Die product does it. So let's go back. You might be saying, well, what is joint whole life and First to Die? And before we get into why we developed this product, I want to make sure that we're all on the same page on what the product actually is. So a joint whole life policy is a First to Die whole life that insures two lives. And it pays the death benefit upon the first person's death. Everything that I say from this point forward will not make sense unless you understand the basics of this product. Two lives, one death benefit, and pays out in the event of the first person's death. Obviously, since we are only paying one death benefit, you're going to get a discount compared to two policies. The discount is somewhere between 25 and 35%. So let's talk about the markets. So there's three main markets that this product fits very, very well in. The first market is individuals who, new family members that may or may not have kids. So let's look at life insurance solutions for the modern family. Most married couples looking for life insurance typically purchase two separate policies, ensuring the lives of both spouses. Joint whole life or first to die insurance works differently in that it allows married couples to share one insurance plan. When one spouse dies, the policy death benefit goes to the surviving spouse, replacing a portion of the income that has been lost. And because one policy is needed, this is going to be a costly way to get the coverage that many married couples need without paying premiums for two individual policies. The second market is the baby boomer market. Consumers are often confused when it comes to the need for life insurance for retirement. The primary argument is that once you retire and no longer have dependents relying on you for financial support, you don't need life insurance coverage. Unfortunately, the reasoning may be great in theory, but it's not necessarily true in practice, especially when it comes to the baby boomer generation. And then the third is the business owner market. We understand that a company would like to have finances to continue to operate after an owner's death. This is a good choice to fund buy-sell policies and protect the lives of key employees and act as an executive fringe benefit. So those are the three markets that this product works great well with. And let's take a look at talking about this just a little bit more in depth in those three markets. So insureds that are younger, married, and they may or may not have children. Well, we understand that these individuals are a little bit different than they were in the past. If you were to look back in the 50s, 60s, people were getting married at younger ages and they were having children. Nowadays, people are waiting longer to get married and have children. Therefore, there's more discretionary income. And with that more discretionary income, they can purchase policies such as whole life, and it makes sense. And I'll even mention this because I really want to highlight Premier Life and Annuities. We received our first ever application for our new product, Joint Whole Life, and it came through an agent under Premier Life and Annuities. That was the first one we ever received. And it was on a 26-year-old and I believe a 24-year-old, which is a perfect fit for this product. They needed $200,000 worth of life insurance, and they were going to pay approximately $218 a month for this insurance. It's going to grow. The death benefit's going to grow. They're going to assume some cash accumulation, and you know what? They're receiving some guarantees. Guarantees in this product or in whole life in general, it guarantees the premium going to stay the same. The premiums will never go up. A death benefit. Assurity's always paid dividends on our whole life insurance, and they're also going to accumulate cash value. Now, why did we put this product on a whole life chassis? It's one thing I may have neglected to state. Well, we really wanted to expand our vast whole life portfolio and reward our policyholders with dividends because we are a mutual company. So now if we look at the baby boomer market, who do we want to target as a baby boomer client? Well, you want to target clients that are in their late 40s and early 50s. Well, why? Because these individuals are typically a little bit healthier than somebody who is 65 or older, and more importantly, the policy, you want it to cover the cost of Social Security replacement. So when you look at Social Security replacement, what's a good starting point for that conversation? Well, the good starting point is replacing at least 5 years of Social Security income. But more importantly, why do you want to target people who are who are younger than 65? Well, you don't want to take what they would be earning on Social Security to pay for this life insurance policy. So you want to plan for this life insurance policy pre-retirement. So that's why the target market in that target market for people trying to attract clients who are approaching retirement are 45 to probably 45 to 63 years of age. Okay, and then the final market that we discussed was for business owners. Business owners, what do they need more than anything? Well, they need a death benefit in case the other business owner would happen to pass away. And secondly, there's always a strong need for cash for cash. Now, typically what happens? The business owner who needs cash to grow or expand his business typically go to the bank. Well, now you're at the mercy of the bank. You're at the mercy of your business, how your business has performed over the last few years. Here, you can provide one policy, one death benefit, and cash accumulation so that if they need cash, they can tap into the policy and utilize loans. So those are the three markets. Those are some of the things that they think about. So let's briefly talk about policy highlights. So this is a whole life policy. It does pay dividends. We can issue this contract all the way through age 85. You can have, you can have a minimum of $10,000 benefit up to $10 million face. We offer non-medical limits. If your client is 60 and below, up to $149,000 worth of insurance. If they're 61 and above, we could offer them $74,000 of coverage, non-medically, meaning they do not have to take an exam. And then we also have a few riders on this policy as well. Joint level term, if you want to bring down the price. We have paid up additions, children's term rider, and joint disability waiver of premium. And Mark, before we open it up for more questions, or if you have some questions, there are a few things that I have been asked a few times when discussing this product or presenting on this product. So the one that always comes up, which is obviously kind of ironic, because I don't know too many clients that will ask this question, but I get it a lot from advisors, is, so you have this joint policy, well, what happens if the clients get divorced? And that is a fair question. We understand 50% of the people get divorced. Well, the good news is that it's probably easier to split up this policy than even a cell phone contract. So what will happen is if they become divorced, we're going to separate the policies. We're going to separate the cash equally. We're going to separate the death benefit equally, without having to go through and see if they are insurable. Another question is, I understand that this product is less expensive, but I only get one death benefit, right? But if I'm paying for two death benefits, my beneficiary would receive two death benefits. Here I'm only receiving one. Well, the good news is that when you're protecting against lost income, you really only need one policy, because the need for the death benefit in the event of the first person's death. So that's the need that we're solving with this product. Why pay for something that they traditionally don't need? And if at that point, when the first spouse dies, you decide, well, you know what, I still do need life insurance. Well, when we designed this product, we thought about that. So there's a survivor benefit. And so if they are under the age of 75, they could purchase a new life insurance plan, whole life insurance plan, no evidence of insurability, and they would start paying premiums at their attained age. Okay, but they would have already still have received a death benefit. And then really the third question is, what happens if we die simultaneously? Like say there was a car wreck or something like that. Well, when we designed this product, we thought of that as well. And the good news is that we would pay double the death benefit if they die within 24 hours. We're going to pay 2 death benefits. Now, when I bring that up, a lot of people will say, okay, well, dying simultaneously, what if we have one person that is in a car accident, one's on life support past 24 hours, let's say they die two days later. How would Assurity look at that? Well, we would still only pay 1 death benefit if one person died. Then what they'd want to do is execute, have the person who's looking over the estate execute the survivor benefit, get their own policy, and if they'd happen to pass away, well, then we would pay out the death benefit on the secondary insured, just like we normally would. So Mark, with that, I know I kind of rambled on for 15 minutes about the product, and I'm real excited about it. We're real excited that we had the first application come from Premier. We think that's that show you how great of a partnership we have with Assurity and Premier, and some typical questions that I get on the product when I go out there and discuss it. So I'm curious to know if you have any questions, Mark, or if anybody on the line has some questions that I could try to answer for them.
Well, I got a question on the line right now from Todd, and it kind of goes into his question on, I'd like to get a feel on the underwriting. He's got a couple that he says, I'd like to see if this is good for them. So can you just go back and highlight, the underwriting? Since it is a first to die, we have to be concerned about the least healthy individual, and also, I think there is a maximum age difference that we want to kind of stay to that gives us a good leverage on the product.
Absolutely. So we will issue the contract through age 85, and we do go with age last birthday. And when we look at underwriting, this policy, most people in the marketplace, they know second to die. Second to die, you can have uninsurables. But this joint whole life, since we are basing it off of the first person's death, we want both of these individuals to be insurable, number one. Number two, you probably want to have 2 people that are somewhat close in rate class, meaning if you have somebody who's preferred best, and then you have somebody who is a table 8, well, when you get into those scenarios, they kind of lose their discount because we're going to base the underwriting off of the person who is least, I don't want to say least insurable, who has the worst rate class. So if you have somebody who's preferred, somebody who's standard, that's still close, we will issue that policy as a standard. When you look at ages, the illustration system will give you the joint age and joint rate class. And so on the rate class, we go with the least of the 2 as far as the worst case scenario. But when we look at the ages, we're going to use a combination age. So if you have somebody who is a male who is 70, let's say, and a female who is 60, then odds are the combination age is going to be 65 or 64. Good thing is, again, the illustration software will solve all those for us. But as far as the underwriting goes, again, both want to be insurable. 1, 2, it's a traditional, fully underwritten product. So both insureds are going to go. We're going to look at both insureds. One cannot be insurable, and we will, if they do want to take, go on a non-med basis. If they're again 60 or younger, under $150,000 worth of face amount, no exams. If they're 61 or older, under $75,000, no exams. Anybody above that would receive more traditionally full underwriting, where they would have to go at least take an exam, blood draw, and urinalysis. And Mark, I hope that kind of helps understanding the underwriting a little bit more.
And I think that does, Bobby. And the other question, or what I would like to see, is that the agents, if they have a case, go ahead and feel free to email that case in with the highlights and everything else. we'll have an underwriter on staff. Our marketers also would be glad to forward that to Assurity. Assurity's underwriting staff would also like to see those, and we can get some pre-ratings and some pre-estimates on this before we even send that in to see if it is acceptable. So we work well with Assurity, so I can suggest to all agents that if you're thinking about a case and there's a little bit of question on health issues, we've got questionnaires plus, our email and email us here at Premier would be a good way to get that done. Another question I have from Alan, are there living benefits? And number one, the living benefit is the cash value. That's guaranteed. It does have some riders available, right, Bobby, on this product?
It does. We do have living benefit riders. So we have some of the living benefits that are associated with this. Okay, so you have paid up additions rider, so we're going to increase the death benefit and the cash value. We do have children's term rider. We do have the joint disability waiver of premium. We do not have the critical illness and disability rider on this policy. That is different than the waiver of premium. We do also have the acceleration of benefits if your clients are, if they would ever go to a nursing home or find out that they'd have 12 months to die, or 12 months to live, excuse me, they would have the capability of accelerating up to $250,000 worth of their death benefit.
All right, so we got some of those riders. We'll look at the product guideline for those when those come out, and we'll be mailing those or emailing those in PDF form to everyone who's registered for this and would like to get that. I got another question from Barb. She's saying, is there a rationale in this policy that will justify the cost of insurance? She's looking at that the whole life is always more expensive, especially when you look at the younger individuals and those kind of things. And I think my justification is guarantees. In this low interest environment, guarantees are something they can't get from any other insurance policies, especially when you're talking IULs, VULs, and those kind of things. So it's a guaranteed product, and it does pay dividends. I can't, those are the clients that you're going to want to try to sell those to, correct, Bobby?
Yeah, I'd say that's correct. And the other thing is, when you're talking to somebody who's younger, the question that I would pose to them is, are you happy with the amount of savings you've accumulated over the last 2 or 3 years? And if you were to ask me that question personally, I would say no. I would say no, I'm not happy with the amount of money that I have accumulated. And you want to know why? Is because, well, one, when they come out with a new TV, what do? I go out and buy that new TV. Well, if I don't have good savings, or if I don't have a way to force myself to save, well, I don't do I don't do very well at saving. So if you can position it to the client where it solves a problem, and that problem could very well be the buildup of cash accumulation for emergencies or for retirement, that is the justification for this product. It's guarantees, it's the dividends, it's the cash value, and it's looking towards the future, not just in the now. And if you look at the younger people, they mainly look, if you ask them a question, what are your goals over the next 2 or 3 years? Well, saving should be one of those goals. And if they're not happy with the amount of money that they're saving, here's a great way that you can help them do forced savings and help them when they have a true need, when they say they lose their job or they need to purchase a new vehicle, they have a baby and they need to pay for their deductible, or a hospital stay. All these different things can all be done in this policy.
Yeah, and when you compare this to CDs and savings accounts at the banks, that's where this will really shine and give you those guaranteed benefits. Last question I have so far is, can I obtain an underwriting guideline for this product? Do we have one available right now, or is it using Assurity's general underwriting product to look at both individuals?
Well, we do have a underwriting guide. So the underwriting guide can be pulled right off of AssureLink, or can be sent from Premier. Now, if you do have a client and you want to do a pre-screen, you can always send those to Premier or Underwriting at Assurity.com, and we can kind of gauge what rate class the client would be. So those are some different avenues to take for those.
All right. Well, I think that's got all the questions there, Bobby, and I'd like to thank everyone for attending today. If you do have questions, make sure you call us here at Premier. Our phone number is 800-365-8208. Ask for a life marketing team, and someone will be able to answer your questions and also get you that information. We'll also have this webinar recorded so we can get it to yourself, and you can share that with anybody else in your office. I'd like to thank you, Bobby. You did a great job. We'll look forward to lots of sales out there and Assurity Life's joint first to die whole life product.
Thanks, Mark. Bobby. Thanks, everyone. I hope you have a great day. Goodbye.